Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit that subscribe button for the latest. Now, our top story, the U.S. economy added 272,000 jobs in May, well above the expected 185,000. However, the unemployment rate rose slightly to 4% from 3.9%. And additionally, average hourly earnings increased by 0.4% from April and 4.1% year over year. Now, this mixed data paints a complex picture. Strong job growth indicates a resilient economy with significant gains in healthcare, government, and the leisure sectors. Yet, the rise in the unemployment rate and a drop in household employment highlight potential challenges. Now, the implications are critical for the Federal Reserve policy. Higher interest rates are traditionally used to curb inflation, but today's data suggests that higher rates might be contributing to inflationary pressures instead. And this has led to a debate on whether the Fed should rethink strategy here. And to help us unpack all of this, we have with us David Nelson. He's a CFA and CMT, and he's also the Chief Strategist at Belpointe. In his latest note, he argues that higher rates might not be the solution to our current economic challenges and calls for a more innovative approach to monetary policy. We're going to find out all about it. Welcome to the show, David. Thanks for joining us.
Hey, thanks for having me.
I appreciate your time. Let's jump into this jobs report. I mean, as I mentioned off the top, increase in non-farm payrolls up to 272,000, far exceeding the consensus of 185. But then unemployment rate ticked up 4% from the 3.9. I'm curious, how do you reconcile these seemingly contradictory indicators? And what do they suggest about the current state of the labor market?
I'm not sure I can, because the numbers are a bit confusing. Maybe even more telling is the differences between the ADP numbers and the BLS numbers, the Bureau of Labor Statistics. They've been very, very different for some time, and makes the question, they can't both be right. Something's not quite right there. Plus the revisions, sometimes very, very large, that we get a month later in these jobs numbers, speaks to the quality of the data. So I'm not quite sure what is going on there, but I think anecdotally, the labor market isn't quite as strong as we think it is. Maybe employers aren't laying people off yet, but hiring has certainly slowed. As a matter of fact, Goldman's out with a note just recently saying that hiring is down to pre-pandemic levels right now. So we'll see how that plays out. But to your point, I do think the Fed is going to have to start to think outside of the box at this point, because they're not slowing down what they need to do, and we're certainly not getting the inflation prints that they need to see.
Yeah, you've got this divergence between the payroll survey and the household survey, the latter showing 400,000 drop in employment. What's the underlying issue here about measuring employment? I mean, these discrepancies are quite high.
They are high, and you've got to remember, sometimes these are just surveys, and they don't necessarily capture the real data. I'm almost willing to shift over to maybe the ADP, because at least that is a consistent process in here. I think when you look at some of these numbers, I think, some like Barry Sterling, some in the real estate industry have kind of pointed out that despite, these dramatic hike in rates, over the last couple of years, despite that, some key areas of employment have not come in. You've seen some pretty big gains in construction throughout the last year. This is the area that should in fact be hit. And maybe what's happening with inflation right now, it's not just the CPI numbers that we get. The shelter inflation, we're gonna have to do something to bring that down, because we're kind of splitting things in two. Those at the top of the income ladder, they're handling inflation just fine. If you're long real estate and stocks, you're doing okay. But if you're at the bottom of the income ladder, all right, consumer staples, the prices are inelastic, meaning the demand isn't going to go down. You still have to buy food. You still have to go to the gas station and fill up. I think they're going to have to think outside the box, and there's some strong evidence that suggests that they're actually going to have to cut rates, and I'll repeat that, cut rates to go this last mile of inflation.
Wow, okay, that's interesting. We're going to unpack that. I mean, obviously the market pricing a little bit here for CPI next week, but let's go back to your note. I read it this morning. You mentioned that higher rates might actually contribute to inflation, particularly by increasing the interest expense for the consumers. I mean, we're definitely feeling the pinch, and the punch. But elaborate a little bit here, David, on how this mechanism works and the implications for the Fed's strategy here.
Sure. And it's not an original thought. I think some, like Rick Reeder over at BlackRock, Jack Manley over at JP Morgan, they brought this up in the past as well. I buy into this thesis in the following sense. If you think about it, in the United States, we're a consumer economy. And it's not as much about the business cycle. It's really more about the housing cycle. And right now, shelter inflation is quite high. And until mortgage rates come down, all right, no one can sell their house. And we can't clear that inventory. So the idea is that if we cut rates even just modestly, enough people can get out from under that they can sell their homes, housing prices will fall, shelter inflation will fall. If I add on to that and I think about it a little further, I think if you look at just a split between the corporate sector, the private sector, between the have and the have-nots, credit inflation is very real. The Apples, the Microsofts of the world, they have pristine balance sheets. The top 10 companies in the S&P 500 have $400 billion in cash. They don't need access to credit. Everyone else does to fund their working capital. And until we get those rates down, I don't think we're going to get this last mile of inflation that the Fed would like to accomplish.
Yeah. Well, could you give me some alternative measures that we could potentially put in? I mean, obviously a rate cut, but what could the Fed do to take if higher rates are indeed exasperating this inflationary pressure? I mean, what can they do here?
I think they could do 2 cuts this year, maybe 25 basis points each cut, bring it down 50 basis points. And right now, real rates, that's what Wall Street looks at. Real rates are the Fed funds rate when you back out inflation. Right now, it's at about 2.7%. Even if we brought it down just 50 basis points, they'll still be in restrictive territory. It's not easy money. As a matter of fact, even with a 50 basis point cut, you're going to be well above, the average of over the last half century for real rates. So it's not easing policy. It's just enough to get out from under to clear this inventory in housing. And I think that's the juggernaut. And that's what I think Rick Reeder, Jack Manley, and even Barry Sternberg over at Starwood are saying here. And I endorse that view as well.
Yeah, let's go back to your recent note here. I mean, you pointed out the government spending remains high. I mean, we all know that. We have record debt. Federal outlays in 2024 amounting to 23.1% of the GDP. It's crazy high. Talk to me about the sustained spending and the impact of the effectiveness on the Fed's monetary policies.
It crowds out the real economy, and the Fed is trying to drain liquidity from the system. And they're not succeeding because the government is pouring it back in. And it's all these programs that we have, whether it's student loan forgiveness, the Inflation Reduction Act, I use that term loosely, the CHIPS Act, all these things add up and pour money back into the economy. And it's unprecedented because you're adding money into an economy that it's not in a crisis situation. It's that we're doing the kind of spending you might see in a financial crisis or a deep recession. And right now, you're dealing with debt deficits that are so large that the juice on the debt, the interest, think of it like a loan shark, that interest rate, that money we're paying each year is going to surpass the amount of money we spend on defense. So that's unsustainable, obviously.
Yeah, and someone's got to pay for it. I mean, if government spending continues to rise, do you think it could offset the intended effects of the Fed's rate hikes? And, what can better be done here to coordinate fiscal and monetary policies? Something has to be done.
Well, you just said it. You're going to have a coordination of fiscal and monetary policy. You can't have, the left hand doing one thing and the right hand doing something else. They're canceling each other out and accomplishing very little. We've gone from the 9%. We're not in those draconian numbers anymore. We come back down, but we're not going to get that last mile until we do something very different than what we're doing. And it's not going to just be cuts and fixing the housing market that, as I suggested, government's got to get their act together. This is an unsustainable path, and you can't tax your way out of it. We can have a debate about a political debate about who's paying too much or too little in taxes, but what isn't up for debate is that we're starting to hit levels of of tax revenue that is crowding out that real economy. We're already at 23, on its way to 24, then 25% of the GDP. Can't do it.
Yeah, interesting data to say the least. Following the jobs report, we saw significant market reactions. We saw a bit of a sell-off in treasuries, a rise in the dollar, and some mixed movement in equities. What do these market responses tell you about the investor sentiment here, especially in all-time highs with the S&P? And as you mentioned, a lot of these Mag 7 having a lot of cash in the bank.
You've seen the market really go back to the mega cap trade, and the mega cap trade, in many ways, that's the safety trade because of the balance sheets of these companies. This is where you go to hide, and I think people have been uncomfortable with that because everybody's looking for the rotation into small caps, mid caps, and other asset classes, and it's just not happening yet. And I don't think that's going to happen until we see rates start to fall, because a lot of these smaller companies, they have adjustable rate debt. They're paying out a lot, just like the consumer. Credit card debt is very, very high, and it's very high for some corporations as well to fund their working capital.
Yeah, talk to the investors here, David. I mean, considering the market's quick shift from higher for longer to now that there's potential rate cuts by the end of the year, how do investors balance between short-term market reactions and then the long-term fundamentals?
That's what we try to do every day, and it's not an easy task. And a lot of times we make bad decisions because we do react in the short term. And I've always thought, sometimes you're selling the stock today and you're buying it back maybe a month later, sometimes at higher prices. So, and many times professionals and retail investors, sometimes we overtrade and overthink it. Some of these companies are great companies, and we can just hold on to them a little longer and forget about trying to avoid, a minor, correction in the market. What's going to be the catalyst to get back in? Even if you avoid a 10% correction in the market, I guarantee you that down 10% is going to feel like we're going down 20, and you'll probably get back into the market when the market's at another all-time high.
Yeah. Well, what are you looking at then in terms of, key indicators when you're checking out to gauge the Fed's next move? I mean, we have CPI next week. That's coming up. How might it influence the Fed's decision-making process? A lot of talking heads this morning saying it's not going to do anything.
I've been wrong for a year on the Fed, so I'm not sure my opinion is going to carry a lot of weight. I've been forced to push out when these cuts are going to happen. The one thing I can tell you is it won't be a surprise. They will let us know probably at least 2 meetings before they actually do it. You'll get a very strong indication. It'll start off with some rhetoric in a meeting, in a press conference, followed up by, Fed speak as these governors come out and kind of talk to the press periodically. And then they'll get a lot closer. You'll see something in the language of a press release. And then finally it'll happen a couple of months later. They're very keen on letting the market know what they're going to do before they do it.
Yeah, and I mean, is the Fed at risk of over-tightening here? I mean, how should they balance this immediate data and then understanding the delayed effects of what's happening? It feels like we're only understanding it months later.
I wish they would read some of the things that I've written and others have written about this. I think maybe at least take a look at it. I think the idea of clearing the inventory in housing should be something that should be tried. I don't think a couple of cuts would be the end of life as we know it, as some in the Fed like to think. Neil Kashkari, Minneapolis Fed governor, he's probably the most vocal. He's not a voting member this time around. He's been the most vocal, but he was part of the easy money. He was on the other side of the boat back in 2021, thinking that there was absolutely no need to raise rates. So I'm not sure how valuable his opinion is right now.
Yeah, David Nelson, Chief Strategist at Belpointe, joining us today to break it all down. It's so interesting. And in fact, I'm going to put up a little link to your Substack because I think more people need to read what you were just putting out there. Hey,
I appreciate that. Thanks so much.
Thank you so much for joining us today. Cheers. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for watching. Don't forget to subscribe, leave a comment who you'd like to see on the show, and we'll see you next time.